Hey everyone, my name is Peter and I'm a passionate well builder. I like to educate people about the various ways they can invest their money. I use properties and stock options as my investment vehicles. And so today I want to talk about stock options because stock options are essentially insurance policies against stock movements, stock price movements. Let's take a look at how a car insurance operates. So you buy this car in here. At this point, you go to the insurance company and you say, okay, I want to insure my car for 12 months. So there is going to be an expiration for that insurance cover. And the insurance company comes back to you and they say, okay, well, we'll take 100% of the risk and you're going to have to pay X. Now, what happens is if you don't want to insure your car for 12 months, let's say you only want to insure it for 3 months, then the insurance company takes much less risk. So they are going to charge you. Why? They're going to charge you less. So what happens is if the insurance company sells you the 12-month cover, then over time, that cover, the value of that cover diminishes because the risk is diminishing. So that's exactly what we do. That's exactly what we benefit from by selling options. So let's take a look at a basic put option. Over here, we can see the chart of a stock price. We can see that it goes up and then down and then up again. It keeps fluctuating as usual. And let's say we purchased this particular stock and we purchased that for $105. As an investor, I don't want to lose, I don't want to risk a lot of money. So I say, okay, I'm comfortable risking up to $100. But if the stock goes below $100, then that's no good. I don't want to take that risk. So what I can do is I can go back to the market and I can purchase an insurance policy that will cover me from here to that point, and that particular insurance policy will have a so-called strike price. The strike price is essentially the same as in case of a car insurance, where the insurance company determines that okay, your car needs to be insured for X amount. So if you buy a cheap car, then they may say, okay, your insurance policy will have to cover you for $3,000. But if you buy an expensive car, it may be $100,000 or $200,000. So the same applies in here. We have a strike price. What it does is, if it ensures me as an investor, as a stock investor, that if the price, the stock price, goes below $100, then I'm protected at that level. So it doesn't matter how far it goes down, I will still be able to sell my stock at $100. But I will have to pay a premium for this. So now let's take a look at it from the other side, from the insurance company's perspective. So because like me personally, I'm an options trader, so I don't normally buy stocks and I don't normally buy put options. I sell them. So this is more or less what it looks like from my perspective as somebody who sells the options. So initially we collect X amount of premium. If everything stays constant, so no external influences, no news, nothing, so everything stays exactly the same, only the time diminishes or the time passes, then we're going to see that premium or that the value of that option diminishing in a nice exponential way. So as time passes, the value of that insurance drops exponentially. So every day it drops a little bit more. But the reality is that there is all these external influences and the price movements that are also influencing the option value. So it would look something like this. As the stock goes up, the stock price goes up, the value of this premium goes down because I am selling a put option. So for me, the person who sold the put option, I want the stock to go up. I want that stock to be above that strike price. So as the stock price starts to come down, in fact, it goes below the strike price, I am as an insurance provider, I'm starting to stress because my premium is now worth more than what I sold it for. So I am at a loss, I'm at a paper loss. But then, fortunately, in this particular situation, fortunately, that stock price bounced back and went up, went well above my $100 strike price. So over time, by the expiration, it became basically worthless. So I pocket all that premium that I collected. So now let's take a look at the basic put option chart in a different context. So this is the P&L chart of a put option. As we can see, the x-axis shows the stock price, while the y-axis shows the P&L, the profit and loss from the put option seller's perspective. Using the example from earlier, we had a $100 strike price. So the seller, the option seller, wants the stock to remain above $100 because that will allow them to collect to keep all that premium that they collected. The funny thing is that even the stock investor wants that to happen because they bought the stock above, most likely above $100, so they don't want to lose money either. So it's a win-win situation. Now, once the price at expiration goes below our break-even point, in this case $99, then the person who sold this put option will lose money, and they can lose as much as $9,900, and we'll cover it in a moment how we calculate all of these things. So the first thing that we need to take into consideration is the strike price, which in our case was $100, and then the premium. So let's assume that we collected $100 premium, but when we're talking about options, every single option covers 100 stocks. So when somebody says, yeah, I collected $100 premium, that's not really what happened. What happened is they collected $1 premium that covers 100 stocks, and the total amount that they received in the trading account was $100. But that would just complicate everybody or complicate all the calculations. So we would always just use the premium per stock. In this case, it would be $1. So our break-even point would be 100 minus 1 equals $99. So what would that translate to as in terms of max loss? So what is the maximum that we could lose in this particular deal? Well, it would be 99 times 100, which is 9,900. And our max profit is $1 times 100. Like I said, every single option covers 100 stocks, so that's where we multiply. So you would rightfully question, how does that make sense? Like, why would anybody go into a deal where you can lose $9,900, but your max profit potential is $100? Well, the simple answer is that most of these trades or deals are providing anywhere between 70 to 85% profit probability. So for a stock price to go from X down to zero, that's very, very rare. Essentially, the company would need to go bankrupt for that to happen. So here I try to simplify the balance sheet as much as possible, so we can see that we have the quantity, the debit, the credit, and the balance. So when we sell a option, then what it means is that the quantity is going to be a negative figure. That is because we're shorting the options. So we sell something that we don't even own. We sell option, and let's say we collect $100. That $100 is sitting in our trading account, but it's not our money until we bring the quantity back to zero. So let's assume that things are going well, and then after, let's say, 2 days or 2 weeks, we're able to buy back this option that we sold for $100 or $1. We are able to buy it back for half the amount. So when we close that deal, then the quantity is going to go down to 0, and our account will be debited by $50. So basically our balance will be $50. What it means is that we made $50 on this deal. So that's, in a very, very high level, a very simplistic way, this is how the balance sheet of our stock option trade looks like. So if you have any questions or you have any comments, feel free to leave comments behind. And also, if you want to get in touch, you can find me at taikonitos.com. You will see the link in the description, and feel free to spread the word and hit the subscribe button and all those things. So until then, I'll see you in the next video. Cheers.